Well, I'm going to get started. If everyone could take out their little packets, I'm going to get started with definitions. I went through this whole presentation a number of years ago, and man, I thought I was on fire. I was giving my very best, my best rendition of this thing. I give this presentation a lot. It's a good introduction to investing. I ended and boy, I felt like I was way on. I felt like I really nailed everything. And someone came up to me afterwards and said, "What's the S&P 500? You know, what's a stock?" And I thought, you know, this whole presentation could have been a little more valuable for that person if they knew what a stock was. So I'm going to bring this down to a level of making sure that just the 5 or 10 definitions that I'll use throughout the presentation you know and understand. Sometimes you'll know what they are, but we use these a little bit differently sometimes in the investing world, so I just want you all to understand them. So just take out this definitions list and I'll go through them. There are 11 of them here that I'll go through. First of all, I just want to express how excited I am that so many of you could come. I didn't know what this would bring. There's 25 or 30 of you here today. There were others that had interest. We're going to do this again. Kids of parents who are here, your folks will come out to these events oftentimes in the evening as well. You're welcome to attend those too. This is not just for kids and you're not allowed to come later. I would love to have you at any events that we do. So if you're ever interested in learning more about investing, you can ask for those emails that your parents are getting. And if you want to get the emails, just give us your email address and we'll send the emails directly to you and you can read about investing as I write and as I speak. You can come and attend these events. I'm glad you're here. This is good business for me to be teaching your younger people about investing, and it's good business for you, as you'll learn a little later, to understand how to do this well yourself from an early age. So good. Let's go through these definitions first. Stocks, we'll talk about. I'll use the word equities and stocks interchangeably. Stocks are ownership in companies. You don't have to own all of Coca-Cola. You can own a little bit of Coca-Cola. You can buy one share of Apple for about $500, and you can have 1/millionth or 1/10,000,000th of its ownership. And you can do that through stocks. Companies can be large, like Apple. They can be really small, like Buffalo Wild Wings is a small company. They can be growth type companies like Amazon. They have lots of income, but they don't own a lot of assets. Or they can be value type companies like Kmart. They make income, but they have a lot of assets. They have a high book value. We'll talk about that in a little while. So stocks of various company kinds are equities, and this is primarily what we're investing in. Although, as you get older, you may want to put bonds in your portfolio. That's the next definition. AKA for the word bonds is fixed income. When you are 25, you don't mind if your investments go up and down in value. When you're 65, you really mind if your investments go up and down in value. When will you have more money in your investments? When you're 25 or 65? 65, right? So let's say you had $1,000 in your investments when you're 25, and let's say the market took a 50% hit. So the market went down 50%. Your 1,000 becomes what? 500. Let's say you had $2 million in your investment account when you're 65. Let's say you only took a 40% hit. What does 2 million become with a 40% hit? 1.2 million. You just dropped $800,000 with less of a percentage hit. So as you get older, you want to own more bonds. Bonds are fixed income. Now, bonds can also be somewhat risky. We want to look at short-term bonds that are high quality. We don't want to look at long-term bonds that are low quality. We'll talk a little bit about that a little bit later. But bonds are fixed income products. It's when you lend your money to either a company or a municipality that you're buying a bond. Bonds get paid first. So if a company is going bankrupt, the owners, the stockholders, they get paid last, which is why it's riskier, why the return is higher. And the bond holders get paid first. Okay? Next one is cost of capital. This is what we've been just talking about. If you want to sound really smart at parties, and someone says, "Hey, tell me about investing. Do you invest? Or what's investing about?" Just look off to the side and say, investing is really a cost of capital story. That's what it is. Just use the word story when you're talking about something that makes you sound smart. Investing is a cost of capital story, but it really is, because when you put your money into a company, okay, when you put your money into an investment, a company or a bond, You're looking for a return on that investment, right? You don't want them to use your money and get nothing. Even when you put your money in a bank, in a CD, you expect to get 0.5% or 1% right now. So you lend your money, or you give your money, your capital, into a company, and a company pays you an investment return. Well, that's what you look at it as an investor. You look at it as a return on your investment. But this company on the other side looks at it and says, we want this person's money as an investment because we're going to use it and we're going to build a building or we're going to start a new product line, right? So Apple takes your investments and they come out with the iPhone 17 or whatever. They look at it as a cost of capital. They want to raise capital. How much does the capital cost? Well, if you get a stock, the cost of capital is higher because the risk is higher to you than a bond. If you give a bond investment from Apple, then you're going to get paid less because it's a guaranteed investment. Does that make sense? So investing is a cost of capital story. An index is a measurement. We'll use the word index fund. An index is a measurement of certain sectors of the market. S&P 500. Does anyone know what the S&P 500 stands for? Any hands raised? Standard & Poor's. It's the 500 largest companies in the United States. And it's simply, the S&P 500 is a measurement of how well those 500 companies are doing. Now, one of the great fallacies in the political world, both sides of the aisle use it, is that once you're in the 500, once you're one of the largest, you're always one of the largest. But the 500 largest companies in the United States are not always the same companies from year to year. About 100 of them are usually always coming off of that list and 100 new ones going on. Everyone's kind of fighting to get on that list of the S&P 500, right? That's the arrival list. You're the largest companies in the United States, and there's a lot of turnover on that list. So there will be some turnover in the S&P 500 index. The Russell 2000 index is less known, but it's similar to the S&P 500 because it's a grouping of stocks. But it's the 2,000 smallest companies in the United States. And this is another index that we use to measure the market, the Russell 2000. So we'll talk a little bit about small companies today as well. A mutual fund is simply something, a company that owns many stocks. You can get an E-Trade account right now and choose stocks and buy them on your own. Some of you may do that already. You may feel more comfortable, however, buying a mutual fund, and that mutual fund owns a number of stocks already for you, right? So they're going to diversify for you into many stocks. And that's simply what a mutual fund is. It's a fund owned by mutual parties, and it owns many other investments. It can own stocks and bonds. It can own stocks of various sizes. It can own stocks of various values. And a mutual fund is what we're talking about here today. An index fund is a kind of mutual fund. This is an index type mutual fund. It's a kind of mutual fund that just buys and sells stocks based on a formula. And then turnover is how often the mutual fund buys and sells companies within it. Okay, we're going to talk about this. This is a big deal. You might circle turnover. I think if I had to make a mutual fund purchase and I was only given one piece of information about the mutual fund, I think the piece of information I'd want to have is how much turnover is in that mutual fund. That's probably the single most important piece of information inside the fund. It tells you a lot about the fund. The next two definitions, active and passive, has to do with turnover. An active mutual fund has a lot of turnover. The mutual fund manager, the person buying and selling stocks within it, in an active fund, they're buying and selling a lot. In a passive fund, they're buying and selling much less frequently. So with an active fund, there's a high turnover. With a passive mutual fund, there's low turnover. Some of this making sense? Okay, so these are some of the definitions. If we have time at the end, I'm going to go through the beliefs or concepts for lifelong successful investing, but I listed them there. I want to make sure that I get through the stuff of the investing truth. And then at the end, I'm going to go through, and I may even pick up some of these concepts along the way as we go. In fact, you know what I am going to do? I'm going to go through a couple of these now because I want to go through compounding with you as we talk about investing. So take out the next 3 pages. And before you look at them too closely, answer a question with a raising of hands. Let's say you decided to invest $1,000 a year for 10 years in your 20s. So you started in your 20s and you invested $1,000 every year for 10 years. Then you stopped investing. So your total investment is how much? $10,000. You're done investing by, let's say, age 35. Then your brother or sister says, you know what, I'm not going to invest until I'm 55 years old. I'm not going to invest anything until I'm 55, but I'm going to put in $100,000. Who has more money at age 65? The person who invested 10. Look how much more. Look at the second column and the third column. If you invest now at age 25, $1,000 per year for 10 years, and then compare that to the invest later. This person waits till age 55 to put 100 in. By age 65, person B has $285,000. Person A has $331,000. B person A, even just a little bit. It doesn't have to be 1,000. It could be 200. It could be 500. It could be 100. The money you invest at this age will be more valuable to you than 10 times this amount invested 20 years from now. Does that make sense? The money you invest today will be more valuable to you in your 60s than 10 times that amount invested 20 or 30 years from now. So invest early. Investing early gives you all kinds of other benefits. It gives you the benefit of learning early. It gives you the benefit of coming to events like this. It gives you the benefit of thinking longer term. Someone who has investments that they know they're not going to touch for 20 or 30 years has something in their head, going around in their head, that's a decade or 2 or 3 from now, which is very difficult for people in their 19, 20, 21, 23-year-old time frame to do. Not much of what you're doing has a very long-term frame to it. But start to be an investor early and you'll get something with a long-term frame, which will help you in just many areas of your life. Look at column 1. I want to look at compounding with you just a little bit. Compounding is one of the best components to investing early. Compounding, someone said, is like the 8th wonder of the world. It's getting interest on interest or getting return on return. If I invest $1,000 at 10% per year, then in that first year I earned how much? 100, right? The next year I have everything invested. Now I have $1,100. My $1,100 is now invested at the same 10% average rate of return. Now what is my return? Is it 100? It's 110. I'm earning interest on top of the interest. I only put the 1,000 in, but now not only am I earning the interest on that 1,000, I'm earning the interest on top of the interest. And if you look at this schedule, age 25 to age 45, your $1,000 became $6,700. Next year's interest on that $6,700 is $670. It's almost as much as your original investment. Pretty quickly, at age 50, your $1,000 will be earning $1,000 every year. And you're doing nothing. The investment is doing it. The market is doing it. Now, a couple of notes about this column. Number one, don't be negative or depressed about small beginnings, right? The book of Proverbs says, don't despise the day of small things. It takes a long time for money to do its work. But when you turn 50, you can see 10,000 then becomes 20, becomes 40 in your 60s, and it really starts to double fast at that point. Recognize that in the early years, the best things you can do, and this is another item on the list, is keep yourself out of debt and invest a little bit. Because if you can keep investing a little bit and not borrow money going backwards, living within your means and keeping investing a little bit, it doesn't matter if you can't invest a lot yet. Later you'll be able to invest more, probably. But let the time work for you and invest a little bit and recognize that even in your 30s, you'll feel like, I only have $20,000 and I'm 35. I thought I was going to be rich with this investing thing. But remind yourself of this schedule. It takes a long time to get to those larger numbers, right? And when you're 45 or 50, you'll probably be making more, and so you can maybe be putting in $10,000 a year. But don't worry about those years. Just worry about staying out of debt and putting a little bit in every year. Save a little bit every year. And this last column is good motivation for saving. It's the inflation column. Everybody heard the word inflation before? What's a good definition of inflation? What's inflation? Go ahead. It has less value. When money has less value. That's probably the best definition of inflation. The other definition of inflation is what?
you have today, you won't be able to buy in the future.
Goods cost more money later, right? Now, if the cost of living is rising, or if eggs and milk are rising in cost, what it means is essentially the first definition: my money isn't worth as much, right? Now, the devaluation of money is really what's happening. Are goods going up in value? Are eggs worth more to me today than before? Do I need to only eat 1 egg a day, whereas yesterday 2 eggs? Probably that is true because I'm 40, and if I eat too much, then I should back up with a different one. Are the goods I'm buying worth more to me today? They're not worth more. They just cost more, right? My money's worth less. Now look at this. If you have $50,000 a year in income, and a college student, this is the median household income. That's why I used it, $50,000 in our area. If $50,000 is your income today when you're 25, by the time you're 65, you would have to have $136,000 in income to feel like $50,000. Does that make sense? To buy what $50,000 would buy today. That's the reason we need the market to invest, because your money is going to be going down in value by 3% per year. You need the market to be raising your investment value by 10% per year to get ahead of it. Not just to keep up with it, but to get ahead of it. Does that make sense? So that's inflation, that's compounding, and that's the time value of money. Those things are the important components to investing. So now, if you have a booklet in front of you, and families have one, I think I have a couple of extra if you want more, we're going to go through this this presentation called Separating Myths from Truth, the story of investing. And you'll be able to take notes along the way. I'm going to get 1 or 2 more for these because we have a few extra. Who wants a Separating Myths booklet that doesn't have one? Did you guys get one? You got one? You guys get one here? I have a couple more here.
You had an incident first.
You had an incident, a tea incident on yours. I'll put another one on the table. So you can fill this out. This is just kind of a good pathway to understanding investing and how to do it wrong and how to do it right. First, we're going to go through investing myths. Then we're going to tell the academic story of investing, and then we'll give you an opportunity if you want to learn more face-to-face. We'll do that for you as well. So a myth is a story that we make up to explain something that's beyond the science of the day or the information we have. And the story I always give on this one is the story of Galileo, where he, with prisms and mirrors, figured out that the Earth was not the center of the universe, but the sun, in fact, was. And everyone thought that the Earth was the center of the universe because they didn't feel themselves moving, and they saw the sun over there in the morning, and they saw the sun over there in the evening, and they felt like, hey, the sun moved, we didn't, and so we must be the center of the universe. Everything must revolve around us. Wasn't true. Galileo showed it to those who could understand his prisms and mirrors. But the key reason I use this this example is that the institutions of the day, primarily during that time, the church, they had a vested interest in keeping that information from the people who wanted to know the truth. And they had reasons for that. The church had their theology and their reasons, and they kept that information. And the same thing is happening in our industry. There's a truth about investing that the establishment benefits when you don't understand. Okay, and I want to show you what those truths are, and I want to show you how they benefit, and I want to show you how you can separate yourself from what they're doing and how they're talking about investments. The myths surround 4 areas. When I take trips, I often sit on planes, and I sit next to people, and what do you talk about when you sit next to someone you've never met, that you'll never meet again? You talk about what you do for a living, right? This will happen to you. You'll sit down, and they say, what do you do? I'm an investment advisor. Great. Oh, any good stocks? I have no idea. It's usually my answer. I don't know. They're a little jaded. They kind of think, okay, I'll try again. What about mutual funds? Do you have a good manager that you watch, that you follow? Do you have a good mutual fund manager? Who's hot right now? You know, Bill Gross was good for a while. Peter Lynch was good back in the 80s. You know, who's a good mutual fund manager? Who can I look at? They get their newspaper out. They're starting to scan the mutual fund tickers. I have no idea. Got nothing for you. So they're wondering, you know, he said he's an investment advisor. I'm going to go one more time. I'm going to give him one more shot. You know, he's failing hard here. He has no idea what he's doing. Not a very good investment advisor, right? So he said, is the market going to go up or down next year? It's 2014, it's about 2015. We're going to see a stock market increase. It was about an 8% increase in the U.S. large companies this year. We're going to see it increase. We're going to go see it decrease next year. What do you think? Should I be in or out? That's what they'll ask. And I'll say, no idea. No idea what's going to happen in the market next year. And they'll say, what is it you said you did again? What's your vocation? I said, I'm an investment advisor. And this myth has everything to do with costs of investing. If I, as an investment advisor, could make you believe that I knew the future, that I could beat the market because I did in the past, or I knew which stocks were going to beat next year, right? Then I could get you to invest your money with me. I can make buy and sell transactions and make money using your money. I don't even have to have any of my own. I could just buy and sell stocks with yours, making all kinds of money with your money. And if I can get you to believe these three myths, then what you can't see won't hurt you, right? Or you think what you can't see won't hurt you. But what you can see is real. And the results that most investors are getting are abysmal as a result of their believing these myths. And I want to kind of debunk them here with you. Now this I think you can maybe see in your book. Stock selection was the first myth. And stock selection is defined this way. It says, the belief, we purchase a stock based on a belief that will do well in the future. And so far, so good. My investor clients own stocks. Okay, they own stocks and bonds. And stock selection is buying investments or buying stocks based on a belief that they'll do well in the future. The myth surrounding stock selection is this, that investment advisors can consistently and predictably add value through individual stock selection. Now let's talk about add value for a minute. On your sheet of definitions, there's the S&P 500. If you would simply own the S&P 500 index fund, you would get a 10% return. Or if you had done this over the last 40 years, you'd have gotten a 10% return average. Now, one of those years would have been 10%. Some of them would have been 50%. Some of them would have been negative 45%. But on average, you would have averaged a positive return of about 10% per year. But if I, as an investment advisor, could buy and sell the right stocks at the right time, I could add value and maybe beat the market, right? And when someone says, what do you do for a living? And I say I'm an investment advisor, that's what they think I do. They think I know how to beat the market. And I'm telling you, the market can't be beat long enough to make a difference. Okay? Some people do for short periods of time. We'll go through that. This isn't in your book, but if you look at this chart, in 1923, the first mutual fund was born. Prior to that time, people invested in stocks. They invested in stocks all by themselves, and they invested as investors, not institutionally. So they didn't have professionals working for them, by and large. They just invested in stocks. In 1923, the first mutual fund was born. In 1924, 3 more were. 2 more were added the next 2 years, then nothing. Then 4 were added in 1928, bringing the total number of mutual funds you could choose from in 1928 to 10. Those were the days, right? Today, you have 30,368 mutual funds you could choose from. There aren't even that many stocks. There are more combinations of stocks that you could buy in mutual fund form than there are stocks themselves out there. And every year now, since about 1963, I think, 61, every year, some of these mutual funds die. Now, why do you think a mutual fund dies? Any guesses? A mutual fund is a company. They buy a bunch of companies. They buy a bunch of stocks or bonds. And if those stocks or bonds do well, they persist. They fail or they don't do well, right? Nobody wants to buy that mutual fund. Now, why would someone not want to buy your mutual fund if you started a mutual fund? You're not bringing back a return, at least the market's return, right? Out of 30, well, let's look at these numbers. Out of 30,586 funds open as of 2013. We're about to get the 2014 number. The total number born during this period were 54,000. The total number killed were 23,000, coming up on half. It's going to be half because on average now, more funds are being killed than are being born over any 10-year period. So we're going to end up with 50% of all mutual funds that have ever been born are going to have been killed. And the average return of the 200 worst dead mutual funds are negative 80%. Now, that information should kind of spark in you, that bites. The the fact that that's there. But here's the even worse information. Once a mutual fund is dead, guess what happens to the data? It vanishes, it disappears. It's not going to be in the prospectus, which is that little piece of paper that an investment company gives you to say, hey, look how well we did. Oh, by the way, we buried these 10 mutual funds last month. That information's not in here anymore, because guess why? The company doesn't exist. So this mutual fund doesn't exist, and their information for that mutual fund is no longer there. They just take everyone's money that's left, the 10 investors that didn't get out, and they move it into something that was more successful, and they move on and hope nobody does the research. Well, we did the research, okay? The Center for Stock Research, or Stock Securities Pricing, CRSP, has all of this data, and we put it back in the numbers. And if you look in your book, you can look at these two graphs. The first one is on page 4. That's the one that's here. Now, I keep talking about the S&P 500. This is the 500 largest companies in the United States. It isn't the same 500 companies in 1973 that made it all the way to the end, but it is always, every year, the 500 largest companies. Sometimes some come in, sometimes some come out, right? Pretty much ever since Apple was a publicly traded company, they've been on it. They're basically the largest company in the world at $560 billion worth of value. They're probably not coming off the S&P 500 fund anytime soon, but GM did. Right? GM was never supposed to come off the S&P 500, and they went all the way down to 0. So it could happen to anyone. And yet, if you simply owned the S&P 500, you can almost own it for free. Your $100,000 invested in 1973 would have been worth $4.7 million. Nobody's guessing. Nobody's buying and selling inside the fund based on a prediction. Nobody's getting in and out of the market at the wrong time. Guess what? This person rode this whole thing all the way down in the early 2000s. They went up all the way until 2007, and they rode this thing all the way down almost 50% in 2008 and 9, and they still ended up with 4.7 million, right? We're not getting out in the right time. I wasn't saying, hey, I think you should get out here. Oh, I think it's about time to get back in. I'm not saying that. I had investors almost all the way through this time. They just remained disciplined, and they grew their money that way. Okay, so if you just held the S&P 500, your $100,000 invested would be worth $4.7 million 41 years later. If you owned the average of all active mutual funds, your $100,000 would have been worth $2.7 million. The wealth lost to active stock management, buying and selling by mutual fund managers, was $2.3 million. Less money on a $100,000 investment than you otherwise would have had. Stock picking doesn't work. Now, stock picking works sometimes for some people. There are 30,000 mutual funds out there. What do you think the likelihood is, out of 30,000 mutual funds that you could pick, that 50 of them are going to beat the market in any given year? What do you think the likelihood is? Give me a percentage. So we got 30,000 mutual funds. What's the likelihood that only 50 of them are going to beat the market in any given year? The likelihood is 100%. It is nearly 100% certain that 50 mutual funds out of 30,000 are going to beat the market. It's just as certain that 50 will beat the market as one football team this year is going to win the NCAA tournament. Someone's going to win. Now, is it going to be Alabama? Is it going to be Oregon? Still ticked at Oregon? Right? I guess the two teams that are in that beat us, or the two teams that beat us that are in the tournament, that's the only consolation we have here as Spartans. But one of them's going to win, right? It's a statistical certainty that one will win. But did we know which one in September? If you were going to make money on that deal, right, when would you have to have known who was going to win? On January 1 at 8 o'clock at night, or whenever the final game is? Well, no, we need to know in September. But who knows in September, right? Who knows which one of these active stock managed companies are going to be the winners back here, and then picked the right one. And then when they started to lose, picked the right one again, and dropped that one and picked the next one, right? We can't know that. And you don't have to know it to do very well. You can do very well simply buying and holding all of the companies of a certain sector and not trying to time the market, like many mutual fund companies do. Make sense? This is 4 mutual fund mixes that we work with. This is now the aggressive mutual fund mix that we work with. This is the growth fund, this is moderate, and this is conservative. And this is the average of all mutual funds, not just stocks now, but bonds included. And the same 40-year period, $100,000 becomes 1.4 with the active managers. And in a passive diversified fund that's aggressive, 100,000 becomes 15 million. So you do not have to try to beat the market. You can even be very conservative, not have to try to beat the market, and do much better than working with folks who are trying to beat the market, who are trying to buy and sell stocks at the right time. Make sense? So stock picking is a myth. If someone says, hey, I've got a great tip. In fact, I get emails like this all the time. And if you're one of them that has sent me one, I'm not meaning this in any negative way. People give me this all the time. I had an email a week and a half ago, even wrote a blog post about it. Hey, we've got this great company my friend told me about. This company's coming out with a new product. I really think the product's cool. I think it's going to do well. And I'd like to cash in some of my Roth IRA with you, and I'd like to put $1,500 in that company. I think it could really do well. That's my clients coming to me and saying, should I do that, or can I do that? Well, you can do it. It's your money. My advice to you is to not do it, because all trades are being made between a buyer and a seller, right? If you want to go in and buy a TV from Meijer today, Meijer has to be willing to let you have it for $300, and you've got to be willing to part with $300, right? Who benefits? If you give them $300 and you take home a TV, who benefits? Both. That's the great thing about the free market. When someone isn't artificially setting prices, both people feel like they got a good deal. Meijer wanted the money. They've got 100 TVs. They don't need another one. You have no TVs. You have $300. You traded. You both benefited. Now, if Meijer set it at $350, less of you would go in buying. My wife and I were buying our Thanksgiving meal food on Thursday morning because we have lots of kids and didn't get to it ahead of time. We're in our line with all the Thanksgiving Day meal stuff, and this guy came through with 3 TVs, 48-inch screens for $170 each. He bought 3. If it was $250 each, he might have only bought 2. Meijer was okay with that trade-off. They're okay at 3 TVs for $170. Probably they bought them for $150 or $140. How you get a whole TV for $140, I have no idea, but the market figured out how to do it, and this guy wants 3 of them, so Merry Christmas to his kids, right? So the stock prices are set mutually. If this guy's willing to part with $1,500 of his money to invest in this company that he thinks has a cool new product, my first question to him is, why is the person who owns those companies willing to sell them to you? Because someone has to let go of their shares of stock if you're going to buy them. Somebody does. There's a finite number of shares of stock until they split or until they issue more. So someone has to be willing to part with those shares. And my question is, who is it? Because out of all the stock trades that are done in this country right now, 98% of them are done by professionals. You're not trading, Dietrich, with Megan, whose other name I know right off the top of my head. You don't get to trade stocks directly. You're trading through a system, and the system is almost always run by professionals. You're buying shares when you buy them from a professional who's willing and who went to school for this and who's willing to sell them to you. So if you're buying on a short-term hunch that this thing's going to do really well, the chances are someone else has that information as well, and if they're willing to sell them, they may have other information too. So stock picking doesn't work. Let's go to the second myth, because this is the one that I really gravitated toward about 15 years ago. I looked at track record investing, and this is where I look at mutual funds, and I look at how well they did in the past. Peter Lynch. Anybody know that name? Parents probably do. Peter Lynch is no longer a household name. Used to be. Probably everybody knew about Peter Lynch, and Mickey Mouse were probably about as well known to everybody. Peter Lynch had the best track record in the industry. He had a mutual fund called the Fidelity Magellan Fund that from 1979 to 1992, for 13 years, it beat the market. Beat the market 11 out of those 13 years. Cumulatively, he was way up over the market, like 3 or 4 points higher than the market on average during that period of time. Peter Lynch could beat the market, everyone said, and money poured into his fund. He made the cover of Money Magazine. He, was on TV. He was on all the investing news when there was investing news. It's not 24/7 back then like it is now, but he was on when there was investing news. And we were using his performance history to determine our best investment for the future. But even though Peter Lynch did it for 13 years, I'll show you that finding funds that did well in the past is not a reliable way for you to do well in the future. If you're an investor today, and let's say you have $1,000 that you want to invest this next summer after you're done working, how long do you need to invest that money to be a successful investor? How long? You're 20 years old, you're 17 years old, you're 22. How long do you need that money to be invested for you to be successful? I would submit to you 50, 60 years, right? Because you're going to retire in your 60s or 70s. Don't think too much about that. That's kind of depressing. You're going to retire at some point, and then even in your retirement, that $1,000 you invested is still going to be spinning off return, right? And it's going to be giving you retirement income into your 70s and 80s and maybe even 90s. The fastest growing demographic in this country right now is the demographic between 100 and 110. There are more people turning 100, between 100 and 110 right now, despite my efforts, than any other group in the country. So you're going to live longer, they say. We never know, but they say you're going to live longer. And this money that you're investing now could be around 70, 80 years. Peter Lynch beat the market 13 years. Two problems with that scenario. Number one, it's only 13 years, and number two, you would have had to find him in 1979, right? Let me illustrate that. This should be in your book as well. From 94 to 2003, the stock market returns were 11%. That's what the S&P return was. Remember, that's market. That's just the 500 largest companies in the United States. But those top 30 mutual funds that beat the market by an average of 7%. Their return was 17. So just so I'm connecting with you here, remember there's 30,000 mutual funds you could choose from? 30 of them beat the market, and not by a little bit. They really killed it. And if you remember compounding, this 17% compounds on last year's 17% and on last year's 17% for 10 years. This is the difference between $100,000 growing to $200,000 versus growing to $400,000. People who had bought one of these mutual funds 4 times their money in 10 years rather than 2 times their money in 10 years. Does that make sense? But when did we get this list? What year? 2004, right? So you're an investor in 2004. Did you enjoy any of these returns? If you were lucky, right? Because we didn't get this list in 1994. There was a whole separate list. The question really is, if you want to do the research and go back, how well does the 10-year list do the next 10 years? That's really what you want to know. Well, here's how well they did the next 10 years. The market did 7.41, and you can own that for almost free. It's an index fund. This fund did 7.14. It underperformed the market. These were the very best mutual funds for 10 years. They topped the market by 7% per year on average, and they underperformed the market the very next 10-year period. Most of the money that Peter Lynch managed by 1992 came in the years 1989 to 1993. Most of the money that came into his fund came in after his run was over. Almost nobody got the return that Peter Lynch was touting over 13 years. Almost nobody got it because they didn't know about him until after he had performed. And by the time he was done performing, all the money comes in, and he underperforms almost the entire 1990s. Now we're frustrated, we come out, guess what we do? We go back and we look for this list. And we reinvest in that list again. And this is how investors invest on average. Probably 95, 96, 97% of all investors invest this way. They go to the top mutual funds from the past 10 years. They put their money in it. When they're frustrated because those mutual funds don't perform, they sell them, or some of them. They go back to the top 10 list of the new day. They invest in it. They get frustrated, and they get about 3 or 4% on average return when the market's giving 10. We should simply get 11 and then 7. Let me give you a 5-year period. The top 30 mutual funds from 2004 to 2008 got a 4.5% return while the market was negative. This was a very negative period of time. If you remember 2008, your mom and dad were probably not all that excited about life. as excited about life. Their market funds were going down all the time, so was the value of their home. It was a rough period of time in the investing money world, right? But there were 30 mutual funds that did better and actually did positive returns during this 5-year period on average rather than negative. So you could have made some pretty good money or lost money. But again, we didn't get this list in 2004. That would have been nice. We got this list in 2009. So how did these funds do the next period? They did 6. How did the market do? You got crushed. You got crushed buying the very best mutual funds of the past 5 years. Just flattened. You got almost no return compared to what the market just gave you for almost free. The very best thing you can do is own the sectors of the market that are known to give the best returns. Don't try to beat the market by getting in and out at the right time and trying to buy someone who just did really well. Those winning periods are short-lived, and they're not long enough for your 60, 70, 80-year need to be a good, solid investor who understands the value of building wealth over time. Okay? So let the market do the work. It will always be better off for you than if you're trying to get into this next thing and do really well this next period. You'll have good periods. You'll make a lot of money at certain times. The 1990s were a great time, and even this last half of this last decade was a very, very good time to be an investor. Those will be there, but you have to be there. And so many people are on the sidelines in these yesterday's winning funds when the market's on a tear, hoping to do well, and they miss the whole thing. So don't miss the whole thing. Always be in. This is the truth about that. A manager's ability to pick stocks in the past has little or no correlation to their ability to pick funds that do well in the future. So don't rely on track records. That's the second one. The third myth is market timing. Market timing is any attempt to alter or change a mix of assets based on a prediction about the future. This is much like stock picking, but a lot of people will do it with their entire fund balance. They'll have a 401k, they'll have $300,000 in it, they'll hear a bunch of news programs, and they'll pull it all out and put it in cash. Well, that's market timing. Money managers or investors trying to utilize market timing strategies to effectively predict up and down markets. If you could have gotten out of the market in October of 07 and gotten back into the market in March of 09, you would have doubled your money over the average investor. Good for you. If you got that lucky, go to Vegas, because that's exactly what you're doing. You're putting it all on black and you're spinning the wheel and you're hoping you're right, because there's no information in October of 07 that would have given you any more assurance than could be the height. We never know. The market's at a new high today. Should I call all my investors and tell them to get out? No. The market's always going to hit new highs. It's been hitting new highs for 89 years and running. Some years lower, and then it comes back up again. So don't try to do this. The Dalbar, you could write down the word Dalbar. I probably should have put it on your definition sheet. Dalbar studies you, and it studies your patterns. Because all stock trades are public knowledge or public information, we can know what you're doing and how you're doing as an investor. Not who you are personally, but given a number. We can know all the equity trades you make. The average investor does less than 4%, while the market does better than 11%. We know when you buy something and we know when you sell it, so we know what the return was while you own stocks. And the average investor is getting 4, while the S&P 500 is getting 11. Let me do a little exercise. How many of you drive? Okay. So of you who drive, how many of you think you are in the 50% to 100 percentile as far as drivers go? I mean, you think you're a little better than average driver. How many of you think you're a better than average driver? Now we have an honest group. Most of the time, most people raise their hands, but kids are in front of their parents right now, so they don't want to make it sound like they drive too fast. Most of us think we're better than average at the things that we do, right? But the average is 3.69% in investing. And unless you're doing something different than the average investor is doing, you're probably going to get roughly 4%. Anyone remember what inflation is on my sheet? That 3% inflation number? That's the average inflation over the last 100 years in this country. That's the average amount percentage-wise that your income or that your money devalues itself every year. And if you're getting 3.69, you're barely keeping up with inflation when the market does far better. Michelle?
Evan, I wanted to ask, why does the market continue to go up? What are the factors that...
Capitalism Yep. Capitalism, this is a great question. And the underlying question is, why should we believe it will continue, right? Well, if you look back even 200, 300, 400 years, if you go to my blog, I don't know, last week I just wrote a post about this. Why do we have the ability to think that the market will continue to give a 10% return? The United States over the last 89 years is unique only in that it has tracked the information so well. But investors have been investing in stocks and companies and products and inventions for centuries. And when you put capital at work, companies create value out of nothing. Let's compare it to a commodity like gold. Gold has 0 expected return over inflation. If you look at the value of gold over the last 100 to 200 years, it has risen by about the same amount as inflation. For periods of time, gold is popular, and so it went up to 1,600 and some an ounce 3-4 years ago, but it's right back down to what, 700 an ounce? I don't know what it is today, but it's right back in line. Gold goes up about 3%, 3.5% per year, right in line with inflation. But capitalism, because gold doesn't create anything. It's a scarce resource, but it doesn't create anything. Commodities don't in and of themselves become more valuable in and of themselves intrinsically. But companies have an intrinsic value creation to it. If you start a company and you put your work and effort into it, you could get, on your own company, you could get a 20 or 30% return on your investment of dollars up front, given the time that you have. On average, capitalism through publicly traded companies has given 10 to 15%. And capitalism over hundreds of years has produced a return greater than the cost of money or the value of money's increase. So companies create something out of nothing. Companies create intrinsic value increases. Apple is worth more today than it was 20 years ago in every measurement, because people are feeding into it and adding value to it and increasing its value. So there's intrinsic value to companies, intrinsic value to these stocks, and that is why they have gotten a return like this. And I'm supposed to say that the past performance is no predictor of future results. I'm supposed to tell you that just because the stock market has given a 10% return for the past 100 years doesn't mean it will for the next 100 years. But I'll also tell you, find me something that's done even half that well, half as consistently. There isn't anything. Capitalism does work, and capitalism isn't bad, as much as seems the general tone in this country would like you to believe it is. Capitalism has created more wealth for people at every level and has brought more people out of poverty than any other system in the world. So it creates wealth, it creates something out of nothing. That's the answer I would give. And as an average, it does it at about 10 or 11%. That's the S&P 500 average. The reason why market timing is so difficult is because so few of the days are so crucial. If you look at a $10,000 investment made, and then a 20-year period of time, let's say 93 to 2013, I simply take these 20 years as a recent 20-year period. We've been doing these for 10 years, and these dates have been, it never matters which 20 years I take, so I'm not cherry picking here, by the way. We're just taking the last 20 years, essentially, and we'll re-update this again next June, and that'll be the new number. So over 20 years, if you put a $10,000 investment into the S&P 500, your $10,000, if you left it invested during the whole period of time, would have been worth over $50,000. But you would have had to leave it in the whole time from 93. And you remember those two big dips in 2001 and then in 2008? You would have had to leave it alone and not touch it the whole time. Now, if you just missed the 10 best trading days out of 5,040 trading days. There were 5,040 days that the stock market was open for trading over that 20-year period. If you missed 10 of those best days, your 10,000 would no longer be worth 52, it would only be worth 28. 10 out of 5,000. Now, it's impossible to just miss the 10 best days, right? You can't know that just as much as you can't know the worst days and get out at the right time. But what this illustrates is that it only takes 10 out of those 5,000 days to create more than half the money increase that you otherwise would have coming to you. It's incredibly difficult to time this volatile, random-seeming market animal. You just need to remain in it. That's been the message, right? That I've been pretty consistent. You just need to remain the whole time. You miss 30 out of the best days, and you actually lost money on your $10,000 investment. That's out of 5,000. That's less than 1% of the days, and you would have lost. Beware of tactical asset allocation. This is just an example of what the industry does. Wall Street, again, they want you to believe they can beat the market. There's a great book by a guy named Malkiel. He writes the book, The Random Walk Down Wall Street. And he says that the Wall Street's biggest game is to convince you that their luck is skill. That's what all of their marketing is for. That's why they have elk and bulls and race cars and all kinds of stuff and celebrities all on their ads to get you to trust that they know what they're doing. But if they can buy and sell stocks inside your mutual fund, they make billions and billions of dollars, when the very best thing you can do is shut that off and not buy and sell anything. Just hold it forever. Because the market does all the work. And even if we find someone that beat the market in the past, we saw already. What are you going to do? You're going to jump on them after they won? That doesn't turn out real well. This guy, Charlie Ellis, says the evidence on investing managers' success with market timing is impressive, and it's overwhelmingly negative. They don't get market returns when they employ market timing strategies. They get much less than market returns when they employ these strategies. So the myth of cost of investing, and this is the fee that's incurred to you every time someone's buying and selling or making a transaction inside your mutual funds. What you don't see can't hurt you. And so they're telling you, hey, trust us, we'll buy and sell for you, we'll get a return better. See, we have all these mutual funds that beat the market these last 10 years, let's buy one of those. And then inside those mutual funds, they're buying and selling, and there are mutual fund fees, and then bid and ask spread fees. In the stock market listings, if you look in the newspaper, there's always two prices for every stock. There's a price if you were going to sell the stock today, and the price if you're going to buy the stock today. How many people knew that ahead of time? It's just a little known fact. The market maker, if you're watching the business news in the morning, it's that black post, and someone's usually running around yelling like a chicken with its head cut off, trying to get you all excited about the opening bell, right? And they're walking around yelling. They've got these little computers on their shoulder. They're doing trades. It used to be with paper, now it's with little computers. And these big black posts with TVs all around them, and everyone's watching the market, and they're buying and selling stocks. They still buy and sell stocks on the trading floor. And it's pretty exciting if you're down there, and it's pretty hard discipline to learn if you're a stock trader, actual one that does the buying and selling. Because when someone calls in and says they want to redeem their mutual fund or they want to sell their shares of IBM, someone on the floor is going to sell those shares. It's got to happen. It's got to actually happen. Someone's got to make that trade. Well, that post isn't free. Those people don't work for free. The big buildings that these big mutual fund companies own aren't free. And there's a spread between the buy price and the ask price that gets paid to the market maker. The market maker owns those posts and pays those people. Back in 1980, one of those posts costs like $2 million to own a post. Today it would be in the billions of dollars just to own a post. And the trading volume is huge. One of the saddest days on Wall Street, in my opinion, is when the trading volume was high and the market movement was negative or little. Because if the market went down, how much money do you have the next day in your mutual fund? Less, right? But there was also high trading volume. So if you own a mutual fund where someone's buying and selling all day long, your fund actually did worse than just the market decline because you actually had to pay that bid-ask spread in the middle of your stock buying and selling. And the fact is, inside your mutual fund, if you buy one with a 401k provider, and if you used a track record to choose it, you probably don't even know how much trading volume is happening inside the fund. Now, on your sheet, we called that turnover. Turnover is usually expressed as a percentage, and I said that turnover, if I had to choose one piece of information, would be the piece of information that I would want to know in order to choose a mutual fund, and it's because of this. And here's the problem. When mutual fund managers buy and sell stocks, we know for sure it's good for them, right? We know they're getting paid every time they buy and sell a stock. But do we know for sure that that trade was good for us? We don't right away, right? It needs to prove out. It needs to prove out over the years. If they sold a company, we hope that company did poorly. If they bought a new company, we hope that company did well. But when do we find out? After the 10 years is over, right? Then we evaluate our investments. And did they do better than the market would have done without all that trading. So it's a conflict of interest, all this trading. We know the trading's good for them. We're not 100% sure it's good for us. And all the evidence I've shown you so far is that it probably isn't very good for us, right? The larger the companies, $5 billion companies, cost less to trade. These small companies, and I'll talk about small companies a little bit, they cost 1.5% just to make a buy and then a 1.5% to sell. The mutual fund managers, I think this quote is here, the bid-ask spread is a percentage of an estimate of actual trading cost. It's almost 30 times as great for small companies than large. And the key question here is this: how much better must an active manager be than the market simply to overcome the cost of his activity or her activity? The answer is daunting, Charlie Ellis says. They're incurring such a high volume of cost or an amount of cost inside your mutual fund that even beating the market isn't enough. They have to beat the market by enough to overcome the cost of their trading, right? And that's the thing that's so difficult to do. So far I've completely depressed you. Everything you thought about investing isn't true. Stock selection is a lie. Track record investing is a lie. Unfortunately, that's the only information they give you when they tell you, hey, let's invest. What are the choices? Well, here are the choices, and here's how well they have done. This is what you're going to get. Market timing doesn't work, so don't try it. And costs are hidden. You can't find them, and they'll kill you. So, how's the pizza? Is it good? Everybody feeling okay? Want some more? But there's the truth. There's the academic approach. There is a way to invest. This part goes much more quickly, and we'll go through it. We call it free market portfolio theory. It's an investment approach based on 50 years of academic research and discipline. So it's discipline on every level. It's discipline on my level based on research and academic truth and fact. It's discipline on your level, despite how you feel. Now again, when you're 26 and you have $1,000 and the market goes down 50%, you don't care, right? You're putting in $500 a year. You're seeing your value go up. But when you're 56 and you've got $1 million and you're putting in $10,000 a year and the market goes down 40%, are you going to be disciplined then? That's a good question. So this is why we're doing these events, so that you can come for the next 30 years, so that by the time that happens, you don't make the biggest mistake in your investing career. It only takes one mistake. You know, one of my clients did sell out their investments in October of 08. Market was almost all the way down, and they gave it up. So it's a disciplined approach. You need to be disciplined. The components of this are that free markets work, modern portfolio theory, and the three-factor model. So in your little definitions sheet, I'm saying free markets work to set prices. This is the philosophy behind this. Harry Markowitz is a Nobel Prize laureate from 1990. In 1952, I think before there were even computers worth using, he built a model that it took until 1990 with enough data and computer power to prove, and when they did prove it, they gave him the prize, and then Merton Miller did that with him in 1990. These guys are at the University of Chicago, and the University of Chicago is where we get this information. If any of you wants to be a good investment manager, an investment advisor, and they want to do it on the academics, go to the University of Chicago or try to get into the Booth School, David Booth. That's where you'd want to go. Rex Sinkveld and Roger Ibbotson are household names in my industry, and these are the guys we're following. It's their research over time. Eugene Fama came up with a three-factor model, and Ken French. I've heard these two guys speak. They're still doing research. I think he's in his mid-70s, and he's now close to 60, and they're doing all the research that we're following on a very regular basis. Free markets work. In a free market, at any point in time, the actual price of a security or a stock is the best indication of its value. Some people will come to me all the time and they'll say, hey, should I buy this stock? I think it's going to go up in value. And I'll say, why do you think that? And why do you think it's going to go up in value more than the 10% the market's going to give you over the long period of time? Do you know that it's going to do better than the market on average? Well, I think it's undervalued right now. Okay. There are 30,000 mutual fund companies run by PhD level mutual fund managers, and none of them are clamoring to buy it. Why do you want to? Well, I think it's undervalued, really. Well, the best indication of a stock's value is its current price today. The information exchange in this country right now is so free, so easy, that all of this information is put into the price, and the best indication of a price is its current value, or best indication of its value is its current price, and that's the model we work on. Okay, so the free market works to set prices, and we don't think prices are wrong. We just assume they're right. Because if you believed free markets failed, you would believe these things, and these are in yellow, red and blue in your packet. You would believe that the market fails to price goods and services appropriately, that it would be possible for some individuals, me or you, to identify some of those mispricings, and then use those under and overvalued markets to predict the future and forecast, and then increase your returns and avoid losses based on that information. So if you believe the markets fail to set prices appropriately, then you would use traditional investment approaches. And I submit to you that you would have to go back to stock picking, track record investing, and market timing. Those are the only three things you could do if you believed this. You would have to use those three approaches to investing, and they're the traditional ones. But if free markets work, then the market is the best determinant of price. All available information is known and factored into price at any given moment. Only new and unknowable information can change the price. And the randomness of the market makes it impossible for any individual or entity to effectively utilize and consistently predict market movements to capture additional returns. And people with this view would utilize a free market strategy like the one I'm about to teach you. So, do free markets work, or do free markets fail to set prices? That's the philosophical question. And if you think free markets work, then we would have a basis of doing business together. If you think free markets fail and that I should be able to tell the future, I'm telling you right now, that's not what I'm signing up for. That's not what you're hiring me to do. And so if that's what you believe, then we have a really good basis to say, glad to know you, and looks like you're looking for a different investment advisor and not me. And you understand why this matters, right? Because the last thing you want to do is 5 years from now come to me and say, hey, the market just went down. I thought you were going to get me out of the market before it went down. Pretty good information for you to have right now, right? That, no, that's not what I'm doing. Right? So let's just be honest about that. I'm not going to protect you from down markets by market timing. I'll protect you from down markets using bonds when you get older. I'm going to coach you in down markets to remain disciplined so that you capture the returns for those who do. That's what I'm going to do. We're not going to predict anything. Because beliefs dictate actions. We would focus on capturing market returns. We eliminate the investment strategies that I discussed earlier. We utilize structured asset classes. We diversify among asset classes that we know provide the best returns over time. We identify your risk tolerance, which does change as you get older. And we work with a coach that shares your belief. Right? Because if free markets fail, you'd focus on active management, traditional investment strategies, staying connected to all sources of financial information, never missing one because you could miss something key, and working with a professional who shares your belief and does that work for you. And this is component 2, diversifying. Harry Markowitz won the Nobel Prize in 1990 for his concepts in 1950. And essentially what he found is that you can increase risk, or you can increase return as you increase risk. Or if you look at the total return, which is over 10% in the S&P 500, you can keep that return and decrease risk by diversifying. And you get a Nobel Prize for figuring that out, right? Because this aggressive portfolio, the negative return in 2008 was 40%. This moderate portfolio, the negative return in 2008 was 16%. Now, if you're 20, you can handle 50%, and you want the positive 13% return over time. But if you're 50 or you're 60, you don't want an account that could go down 40%, right? You don't want a high volatility account with a high volatility number here. You want an account that can only go down 10 or 15%. You can weather that. And the S&P 500 has the similar amount of return as this modern portfolio or moderate portfolio, but this portfolio has half the risk associated with it. And so Harry Markowitz got the Nobel Prize for doing that because he determined that asset allocation, or where you diversified, was the key. So this is getting a bit academic, but this is the picture form of it. If you invest in two investments, one goes up while the other goes down intrinsically, then you can be on the purple line, and you can get from point A to point B using volatile asset classes and not have as much volatility. Does that make sense? You've seen this in an investment class probably. This is the picture of diversification. Almost nobody does it. This is something that can be measured, by the way. So if you have a portfolio and you want to have it measured, we can measure how much diversification you have. We can measure what your standard deviation of risk is. This would be like owning in Florida, you own a balloon company and you own an umbrella company, right? If it's raining, you're making money. And if it's sunny, you're making money. Just not at the same time in either company, unless you're a really good salesperson, right? So we take the 100% S&P 500. You have an annualized gross expected return of 10 and a standard deviation of risk that's pretty high at 17. If you add international, 30%, so now you have 70% US, 30% international, you see the return go up, you see the risk go down. You add small international, only 10%, the return goes up even further, and the risk goes down even further. So you have the standard deviation of risk moving that way, and you've got the return moving up, and the academics have shown us how to do this, and I am standing on broad shoulders there. I could not explain it to you in logarithm form. I don't need to. I have the data, and that's the data that I'm continually learning and bringing to my clients so that you can have the same benefits of lesser risk and higher returns appropriate to your age and to your category and to the purpose of the money that you have. Some of you had to leave in the 115 to 130 range. Looks like I'm going to go a little past that, but I might be done at 130, so we'll keep going. If you have to take off, don't hesitate. Just sneak out, no problem. So there are three areas where returns come from. They come from the stock market, then they come from small companies, and they come from value companies. And I'll just go through this quickly. Just suffice to say, there are different kinds of investments you can make. You're going to invest in stocks, but there are big companies and small companies, there are value companies, and there are growth companies. We're diversifying among all of them. I'll show you that in a minute. The equities or stocks get a better return than treasuries or than fixed income, and the risk is higher. Okay, so we want to invest where we get a better return. We want to take risk where risk is rewarded. Factor 2 is the size factor. The small companies get a better return than large companies do, and the risk is higher. So we'll take small companies for its premium, and we'll add it to your portfolio. And then we'll look at value companies. Value companies are those companies that are lower price right now compared to their book value. Lots of detail there, but their return is almost 2% better. Even though their risk is higher, their return's better. But as you saw, you can add risky components together, and because they have dissimilar price movement, it doesn't mean your total portfolio gets riskier, right? You can diversify that away. So the academic approach is looking at free markets, modern portfolio theory, and the three-factor model, and you get the Mattson's free market portfolio theory. We call it Mattson's because I work with a company called Mattson Money for the mutual funds. Okay, now we're going to build it. And this is in your book, so you just want to write these numbers down in the last pages. And then we're coming around third, heading for home. So this is page 17. And remember, most people are in the, they're getting a return from Dalbar at about 3.69%, and they have a high standard deviation of risk. And it's because they're not holding investments very long. They're buying and selling. They're track record investing, chasing the market. They're active stock picking and their market timing. They're doing all of these things, and so the average investor is doing very poorly. And the first thing we want to do is convert you from an active investor to a passive investor so that you're simply holding market and you're not trying to time the market. And if you do that, you can increase your return significantly and decrease your risk even a little bit. Then we want to start diversifying. And first we're going to put fixed income in here. Now, at a younger age, in your late teens and 20s, if you're investing, you probably don't want to have this much in your portfolio in fixed income, in the bond section, the fixed income section. But we're going to do it because that's what's approved through FINRA for me to tell you about. And so we have to get all of this approved. So we're going to just do this one. This is a little bit more conservative than you'd want to be, but it's a good illustration. You can decrease your risk number considerably, and it doesn't have to decrease your return number as much. So by adding 40% into the bonds from the stocks, you decrease your risk and you decrease your return a little. Now let's work on bringing that return back up. Let's add some higher valued components. We're going to go international. We're going to increase the return a little bit and decrease standard deviation or risk. Then we're going to add small companies, both here and international. We increase our return now above even the S&P 500 performance, and we kept risk pretty low. And now we add the value companies, small and large value, and we increase risk or returns again, and we actually decreased risk that time. So now, instead of having a 10% rate of return with 17% risk, we have an 11% rate of return with 11% risk, and this academic approach works inside your portfolio.
Are all of these investing the same amount of
It doesn't matter how much you invest, you'll get those returns. I have investors with $1 million. I have investors with $1,000. Frankly, the $1,000 investor is usually more disciplined than the $1 million investor is. Here's the thing. It's a good question. The amounts of money. Anybody have any idea how much money is in the U.S. stock market right now? Trillions. It's in the 30 to 40 trillion range. Okay? So let me give you a sense for what that means compared to your money. Here's 30 trillion. This is what's in the market. Okay? Now, if you have $1,000 and you're putting that in the market, that almost doesn't show up, right? There's your 1,000. Do you think the 30 trillion cares about you? Let's work with the 30 trillion based on what the academics tell us. Let's not get chewed up and spit out, right? But do you want to know what the $1 million line looks like? It looks about the same. Against $30 trillion, if you have $1 million or you have $1,000, the market would just as soon spit you up and chew you up and spit you out and doesn't care about you. $1 million is not a lot of money when you're playing with the stock market. Now, it's a lot of money, and it creates a lot of responsibility, and it does a lot of good for you and your family and for others. $1 million is a big responsibility. But in the context of the marketplace that you're entering to invest, my $1 million clients will be prone to be less disciplined. They'll be prone to panic more. They'll be prone to think more of themselves and the information that they have, right? And so I am much slower to take $1 million client than I am to take a young person who's willing to learn and do this right from the beginning, which is why you're here. It's why your parents want you here, because if you can get 10 or 11% your whole life, you get to invest half as much money as they had to get what they got. Because it took them until they were 35 to learn this stuff, or 40, and they made some mistakes ahead of time, and they didn't get the kind of return that you can get. So you can invest less, but it doesn't matter who you are. You put 1,000 in, you get 10%. You put 10,000 in, you get 10%. There's a book out there about the Fortune 400 companies in the United States. Everybody know the Fortune 400? The richest 400 people in the United States are on a list, and they're called the Fortune 400 families, people. And it's really sad. Once they're on the list, the only thing they want to seem to do is raise their value. So they're some of the frugalest people in the world, because they don't like to spend anything unless it ends up in their net worth, right? Unless it brings them up a notch from 380 to 370, right? Well, the rate of return that we're getting for our clients over the last 22 years is a higher rate of return than the Fortune 400 families get in their investments on average. You got the 400 wealthiest, they're all billionaires, wealthiest individuals in the entire United States, and our return in our investments on average is greater than theirs is. They don't tend to want to make money. They tend to try to protect it. They're a little afraid of losing it. And we should be concerned too, but if you pay attention to market factors and you submit to what we understand and you not try to be smarter than it, you can do extremely well. And given a few generations, you can oust any of those guys. It's just a matter of time, right? So that's the truth. So if I can get this clicker to keep working. I think it stopped working. Maybe I turned it off. There we go. So the free market equity fund, the free market fixed income fund, and the international equity fund is what we are invested in. 18 separate asset classes. 13,000 companies. Remember when I talked about people wanting to buy one company? Single stock risk is a huge negative. We own 13,000 companies in 46 countries with free markets in them. When I started in this over 10 years ago, there were 38 countries that had verifiable ownership records and title defense and free markets to trade. There are now 46 countries with free markets. Free markets are expanding. Capitalism is expanding because capitalism is the best system to help everybody. It levels the playing field. It brings people out of poverty. It levels the very rich when they make a dumb decision, right? They can come down just as fast as someone in poverty can come up. That's the thing I hated about this too big to fail policy stuff about the banks that all got bailed out in 2008. Hey, if a bank made a bad decision, let them fall. You know what they just did is they just helped the banks, and they kept them going when they didn't deserve it. And it wasn't right, because all the little banks now that are doing it right, they're struggling because the big banks have these federal policies in place to protect them. It's not fair. It's not free market fair. And it's not best for all of us. It's best when the giants can fall. That way, the young and small can grow up and do it well. But we're looking for free markets. We're looking to increase that around the world. I'm going to go through these questions quickly. They're all in your book. The 20 must-answer questions for peace of mind. You can answer yes or no to these. The only the only thing that I ask you to do is that unless the answer is a 100% emphatic yes, that you would either leave it blank or answer no. So you're looking to answer 100% emphatic yes, I know that is a yes, or you're going to answer it no. And the first question is this: have you discovered your purpose for money, that which is more important than money itself? And I would suggest that this is the number one important question for you in order to be a good investor over a long period of time. Understand what money is for and what it's not. I think on my definitions sheet I listed contentedness and giving. If you don't give some of your money away every year, your contentedness is going to be less. And if you're not a content person, you won't be a happy person, you won't be a good investor. You'll generally be chasing things rather than building things. Number two, are you invested in the market? I think everybody should be. Even my retired clients have 25% of their money in the stock market. You can be, and you don't have to be too aggressive if you are. Question three, do you know how markets work? Question four, have you defined your investment philosophy? Do free markets work to set prices or do they not? So if you know, I believe free markets work to set prices, you can answer yes to that. If you're not sure, you can do more research or ask me a bunch of questions later. Have you identified your risk tolerance? Do you know how to measure diversification in your portfolio? Next question, do you achieve market returns consistently, predictably in your portfolios? Some of you have portfolios. Are you getting market returns? Have you measured the amount of commissions and costs being paid to your advisors and to the turnover contributors? Do you know where you fall on the Markowitz efficient frontier? When it comes to building your investment portfolio, do you know exactly what you're doing and why you're doing it? Or are you guessing, or are you just trusting someone, or are you hopeful? Hope is not a strategy. I like hope, but it's not a strategy. Question 11, are you working with a financial coach versus a financial planner? 12, do you have a customized game plan to guide your lifelong spending decisions, or a customized lifelong game plan to guide all of your investing and spending decisions? Do you have an investment policy statement, something that says how your investment managers are going to act in up and down markets? You know, if the market crashes, what are we going to do? Do you know that ahead of time? Have you devised a clear-cut method for measuring the success or failure of your portfolio? 15, do you fully understand the implications and applications of diversification inside your portfolio? It can be measured, it can be shown to you. Do you have a system to measure volatility? How much could your portfolio go down in a given year, given what you're invested in? The fact that it could go down is not the problem. Is it going to go down more than you expect, and are you going to freak out when that happens? That's the problem. So if you know your portfolio could go down 50%, and you know how you're going to react when that happens, and you know what we're going to do when that happens, 50% decline in the market is almost the best thing that could happen. Warren Buffett, everybody know who Warren Buffett is? Lots of people know Warren Buffett. He says, I would pay you a considerable sum of money if you could tell me with certainty that tomorrow stocks I currently own are going down in value. And I would pay you a lot of money to make that happen, because he would simply go buy more of them at a sale price. He would buy them from someone who's freaking out, who don't deserve the cost of capital that they invested from because they don't understand why they're investing or how to do it. So don't let Warren Buffett win on your investments. Don't panic. Know what your investments can do and know how to respond when that happens. Are you aware of the cost associated with purchasing commission-based products? I'm speaking of annuities here primarily. Commissions are huge on these. I'm not a big proponent. Do you know the 3 warning signs that you may be speculating with your money versus prudently investing it? Speculating versus investing, track record investing, stock picking, and market timing. Those are the 3, so you can write yes to that one. Question 19, can you identify the cultural messages and personal mindsets about money that destroy your investing peace of mind? You're going to be developing some of those as you turn from teenagers into 20s into 30s. Do you Do you see your commercials, or do you see what other people's have? Do you compare yourself to other people financially, what they have? And do you let that destroy your peace of mind? It's good to get honest about that stuff and just deal with it. And then 20, are you ready to shift your personal experience of money and investing from a scarcity mode to an abundance mode? This is the one I'd like for you all to just check yes to, so that you can start the track of learning how to invest and learning how to not speculate with your money. So that's my presentation. I want you to fill out a card for me. So if you could find that card. I may be the only investment advisor in the world collecting cards from someone under the age of 20 asking for an investment meeting with you, but that's what I'm going to do because it's for your best benefit, and your parents want me to, and it would be good for all of us to do. So I would like each person here to fill out their name and address, a phone number that works for you if you have one, otherwise just write my parents, and an email if you have one, and if your mom and dad say it's okay to give to me, you can give me that as well. I have your address if you still live at home. And if you want to meet with me, just check that top box, and we could do this over the phone. We can do this with your parents, however you guys feel most comfortable. And I would like to meet with you personally and answer other questions that you have. And you can also attend the event in July, or you parents can say, I want to attend the event in July. And then you can write comments or questions. If you have a question for me, you can write that in the bottom, and I will make sure I get an answer to you directly. Please hand these in to Liz on the way out. I would love to collect them from you. And starting a relationship with an investment advisor is a good thing. And you have to do it eventually. Most people won't do it until their mid-30s. And again, you don't have to have $100,000 to invest or to become a good investor. Don't despise the day of small things. Put $100 away, put $1,000 away, and get started now, because it will do you great wonders and good favors all your life. So glad you were here. Jordan.
This might be kind of a silly question, but do you have to be 18 to invest?
In your own name with your own number, yes, but there are types of accounts that for the benefit of kids that you can have in your name, and I have people in this room right now that invest and they're under 18 with their parents' help, and then it gets shifted over at their age 18 for their own benefit in their own name. Yep. Good question. People under 18 can't sign legal contracts, and so they're not allowed to enter into an ownership situation. Yeah, there's more pizza. Please eat more pizza and more pop and stuff like that to drink. Any questions? I'd love to answer questions. There's more I could talk about. Some of you need to leave, and I'd be glad to just let you out, but Jamie.
I don't know if there's a quick answer to this, but with this age group, I know a lot of them are hearing things like this versus whole life insurance.
Oh, no, you're right.
In terms of building that long-term wealth.
Yeah. And where are they hearing the whole life from?
Not from me.
My first job after college, I was recruited by a Northwestern Mutual life insurance agent at the age of 22 to be a whole life insurance agent salesperson. I lasted 3 months and I was out and didn't want to get back into selling. I think I went to California and looked at the mountains for 3 months. It was the most depressing thing in my life. Insurance sales can be really good. And I was a mortgage salesperson for a lot of years. We did very well. I still have, Keith Hall's walking around here. He's with Churchill Mortgage. He does mortgages, life insurance. We need these products. But whole life insurance is when you combine an insurance product with an investment, these two will intersect in whole life. Now, if you came away with one message today, don't intersect insurance or investments. Okay? Don't intersect entertainment with investing. Okay? Don't let those intersect. That's called Vegas. Don't go to Vegas either. But definitely don't go to Vegas with your investments, because it's not an investment, and don't stock pick with your investments because it's like Vegas. Got it? But insurance and investing ought to be separate, because the investments inside of an insurance policy can never be as good as the investments on the outside, and it's again shielded with another layer of cost, another layer of veil that keeps you from seeing what the investments are in. You want to buy term insurance Term insurance is the insurance that is here for 10 years or 20 years or 30 years. And then when your net worth grows, your insurance goes away because you don't need it anymore. But invest separately than insurance. Don't put them together. And you're gonna hear about it because, I don't know, what is it? 1% of your friends or people you know in school are going to become a whole life insurance agent like I did at age 22 because it's, you don't even have to do well in school to get it. They'll take anybody. It's, I'm another good explanation of that reality. But it's an easy thing to get into, and they'll ask for their, your family list, and then you'll give your family list, and you'll call everyone in your family and try to sell them whole life insurance, and that's how the thing works. And so you are going to get a call or 2 or 10 from people you knew in high school that say, hey, I'm now with Pacific Life, or I'm with Northwestern Mutual Life, and I'd love to talk to you about your future and understand what your goals are. And that's really code for I want to sell you a $100 life insurance policy, $100 a month. And don't buy it as an investment. Buy term from them. You need term insurance probably, and the sooner you get term insurance, the better on your own because it protects your insurability. These are things we can talk about sometime. But stay away from whole life insurance as an investment. Thanks. Good question. And it is probably one that almost everybody here is going to get hit up with. And whole life insurance is not a good investment. So, good question. Other questions from parents or others? Great. I think I have some calls scheduled for a couple hours from now, but I'm pretty free, so I'm glad to just stick around and talk as long as anyone wants to. There is more pizza, more soda, so hang around. And thank you for coming. And tell others about it too. Thanks. We're going to do more of these events. We're going to try to do a lunch event in the summer again. We're going to do this again next winter. Anyone here is welcome to come to our events. I think in April we're going to do Mind Over Money. Some of you have been to that already. We're going to do that again. We haven't done that for about a year. In January we've got another one. Avail yourself to these. I like full rooms, and I don't mind if some of you are young and not yet investors. It's still good that you're coming and learning. So I mean that. 20th and 28th for January. Great. And January is right back here, right? Yes. So, great. Thanks for coming.